There are moments in trading when doing less is a decision, not a hesitation. In this gold position, keeping the stop unchanged for a few days gave the trade enough room to stay alive and move into profit. That is easy to celebrate after the fact. The harder lesson is that the quality of a trade often depends on surviving noise before the market reveals its direction. Gold has been under pressure, while war-related headlines have pushed risk sentiment across markets, including BTC and the S&P 500. At the same time, crude oil has rebounded, and that matters more than people think. When oil rises while other assets are under stress, the market starts questioning whether this is a clean risk-off move or just a temporary defensive reaction. That distinction matters because correlations do not stay stable when the regime changes. Gold can trade like a safe haven one day and like part of the same risk complex the next. BTC can react to the same headline flow. Equities can sell off in sympathy. The market is not always telling one simple story. In this case, the trade benefited from restraint. A stop that is not moved too quickly can avoid being taken out by ordinary volatility when the original thesis is still intact. The position was allowed room to breathe, and the move extended instead of ending prematurely. But that is only the trade-level view. The more important question is portfolio-level risk. A profitable long position does not mean the whole book is safe. In options, you can be right on one instrument and still be fragile overall. A short volatility book can be hurt by volatility expansion, correlation spikes, or a move that is faster and more disorderly than expected. That is why not trailing a stop is not the same as being careless. Good risk management is not always fast risk management. If the stop is too tight, normal noise becomes a realized loss. If the decision not to trail is based on market structure, regime awareness, and a clear invalidation point, it can be the right move. The danger is when restraint becomes hope. If you are not trailing the stop because you do not want to face uncertainty, that is not discipline. That is avoidance. The difference is whether you already know what would prove the thesis wrong. And in a risk-off environment, that question becomes even more important for options portfolios. The short positions may still be waiting to expire, but the market can reprice quickly. Even without a dramatic crash, changes in implied volatility, correlation, and directional flow can damage a book that is structurally short optionality. So the practical lesson is not to abandon the trade. It is to define the next action before the market forces it. Review the hedges. Check concentration. Identify where the portfolio is short convexity. Decide what gets reduced first if risk sentiment worsens. This trade is a reminder that stop placement should reflect the job of the position inside the broader portfolio. Sometimes restraint preserves edge. Sometimes it preserves exposure long enough for the thesis to work. But that same restraint has to be matched by a clear plan for the next regime change. In the short run, the position is in profit. In the long run, the real test is whether the portfolio is built to survive the next turn in risk sentiment. That is where discipline lives, not in being right once, but in staying solvent and adaptable long enough to compound through changing regimes.